What's going on, everybody? All is well. So, today I would like to talk about three of the best ETFs for beginners. I know investing in the stock market for the first time could be overwhelming, but by simply understanding and investing into an ETF, it could simplify the process when it comes to investing into the stock market. Now, I like ETFs personally because one, it gives you instant diversification. Two, you're exposed to some of the best companies in the stock market. And three is you take on little to no risk because you're so diversified within the stock market. All right, now let's get into my first ETF. And my first is VOO, which is a Vanguard S&P 500 ETF. Now, what's the ETF? An ETF stands for Exchange Traded Fund. Basically, it's a basket of stocks all under one ETF. So, under VOO, just by investing into VOO, you'll have exposure to some of the best companies in the S&P 500. And right here on Seeking Alpha, you go to Holdings, and this is the sector breakdown of the ETF. So as you can see, 35% is exposed to technology, financial is 13, consumer cyclical is 10, and so forth and so forth. Now, you scroll down to the top 10 holdings within VOO. You see some of the best of the best. We got Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet Class A, which is Google, Alphabet Class C, Google again, and Berkshire Hathaway, and we got Tesla. So these are the top 10 holdings, all within VOO. So just by investing into VOO, you got automatically you're exposed to some of the best companies in the stock market right off the bat. All right. And another thing I want to touch on when it comes to ETFs or their expense ratio, and this is why I like Vanguard, because they're known to having very low expense ratio. Basically, expense ratio is a fee that gets deducted from your holdings every year, and it's basically for managing, a fee for passively managing the fund. So now you see the expense ratio is 0.03%. That means annually they're gonna deduct 30 cents per $1,000 invested into VOO annually, and that's you're not even going to notice that amount getting taken out annually from VOO. Now there are other ETFs that have higher expense ratios, and that I tend to stay away from ETFs that carry very high expense ratios because it might not seem like much now, but over time, as you continue to invest, that the expense ratio, it kind of eats into your profits within that particular ETF over time. So that's one thing I look for when investing into an ETF is how low is that expense ratio. Like I said, Vanguard has some of the best ETFs with some of the lowest expense ratios. All right, so this is VOO. Like I said, you're automatically exposed to 500 of the best companies in the stock market. You cannot go wrong with VOO. Another alternative for that is VTI. Either one is perfectly fine. They're very, very similar. VOO tracks the S&P 500. VTI is Vanguard's total stock market index fund. basically you're exposed to just about everything in the stock market. As you could see when you scroll down, top 10 holdings identical to VOO, and you look here, number of holdings, and as you can see within VTI, there are 3,529 total stocks that make up this ETF. All right. And also same expense ratio, 0.03% as VOO. Now I'll give you another one, another alternative. I believe it's SPLG. Yes. Now obviously right off the bat, this also tracks the S&P 500, but the price is a lot less than VOO or VTI. And the expense ratio is lower, sitting at 0.02%. And you just go to the holdings. It's practically the same. See? Practically the same. So, and as you can see, the number of holdings is 506. Now this tracks the S&P 500. It's identical to VOO, but it's a personal preference. You cannot go wrong with either three of these options. So you just pick one and just stick to it, and they're going to perform very similarly, because as you can see, all three of them have similar holdings. All right. So next up, we have our dividend ETF. And one of the best dividend ETFs out there is SCHD. This is Charles Schwab US Dividend Equity ETF. These are a lot of solid companies that kind of boring, but very, very solid when it comes to withstanding volatility in the market. Now, might not run up as fast as let's say a Microsoft or a Nvidia. When Nvidia gets going, it just takes off. These companies are very slow and steady, very boring, but solid companies overall. All right. And let's look at the top 10 holdings in SCHD. You got PepsiCo, we got AbbVie, we got Home Depot, we got Cisco Systems, we got Verizon, Ultra Group, Chevron. Very boring, companies. But SCHG is your dividend ETF. And basically, this is the most reliable dividend paying ETF out there. And let's go down. So as you can see, the dividend growth is 13 years. So for the last 13 years, SCHG has been consistently growing their dividends. And as you can see, currently they pay out 26 cents per share each and every quarter. So they're going to pay out every 3 months. And there's 4 quarters in the year. All right, and let's just take a look at the dividend history. Let's go from its inception. Man. And as you can see, from the start, it's been slowly increasing their dividend payout. Slowly but surely, it's been increasing year over year. Just continue to increase their dividend payout. So yeah, that's SCHD, one of the best dividend paying ETFs out there. And you pair this like a SCHD with a VTI, a VOO, or SPLG. Those two alone, you're good to go in the stock market, especially when you don't have a lot of time to do a lot of research on individual companies, or you got a busy lifestyle. You got the kids, taking care of the kids and whatnot. You just rock out. You could rock out with those two, and just every month, dollar cost average into these two ETFs, and you'll be set. You'll be set. You know, it's really it could really be that simple when it comes to investing into the stock market. It don't have to be difficult at all. You know, but it, like I said, it all depends on the individual uh, risk tolerance and their investment style. It all comes down to individual, you know, how they would like to go about go about investing into the stock market. But there's no right or wrong uh, reason, no right or wrong way to go about investing. It's just personal preference. Like some people risk tolerance are higher than others. This is just I'm just showing you an example of one of the safest ways to get started when it comes to investing into the stock market. And even if this is your style, it's completely fine to just stick to your investment style. Do not worry about what somebody else is doing. Just run your race at your pace. You know, you're gonna be fine. All right. So let's move on. The third ETF, and this is VUG. This is the Vanguard Growth Index ETF. Now, this ETF consists of a lot of growth stocks, a lot of stocks that when the market is green, they're going to take off. But when there's volatility in the market, they're going to take a hit as well. And as you can see, Vanguard again, very low expense ratio, 0.04%. And let's go to top 10 holdings in VUG. As you can see, 50%, more than half of this ETF is exposed to the technology sector. And you scroll down, you got your usual suspects, the Nvidias, the Microsoft, the Apples, the Amazons, Meta, and so forth. Now let's look at the chart. Let's go 10 years out. Now, as you can see, this by this chart pattern, you see when the market goes green, it runs. But you see these little dips, these are pullback in the market. It'll pull back, it'll drop, boop. But once it found support, it'll run right back up. And then it'll drop again, and it'll run right back up. And as you can see right here, it just nosedive, found support, bounces right back up. You know, but that's the thing about that. That's what comes with growth stocks. They run up fast, but when the market pulls back, they're gonna take a dip. But you need to understand that, and don't panic when you see that happen in the stock market. Pullbacks, crashes are all normal. It's all part of the cycle of the stock market. And as long as you continue this dollar cost average and don't freak out, don't panic sell, it's gonna be all right. It's gonna be perfectly fine, because as long as you don't sell, you don't lock in that loss, because it's just a loss. It'll just be a loss on paper. As long as you don't sell it, it's just a loss on paper. And then when the market recovers, it's gonna run right back up, and you'll be a-okay. All right. But yeah, those are three of the best ETFs that I like, especially when you're a beginner investor in the stock market. And it's really just comes down to your mindset, being disciplined and consistent, and blocking out all the outside noise. Oh, you're gonna hear people talk a lot of craziness about the stock market. Oh, it's rigged, yada yada yada. Yes, it's rigged. It's rigged to go higher long term. That's why before you even considering getting into like options trading, leap trading, um, buying and selling cash secure um, puts and all that, you need to get your foundation established and just understand the fundamentals of investing into the stock market. All right, and take it from there. you know but yeah, anyways, I hope this video was helpful. you know Hope you guys enjoyed it. Like, comment, subscribe, all that good stuff, and until next time, you guys be safe and enjoy the rest of the day. All right, peace.